Hello, everyone. My name is Dan Holloway, and I want to welcome you all to our webinar on the best states for commercial and industrial solar PPAs. We've seen a lot of changes within the CNI market for solar in the last couple of years, and we would like to provide you all with some of the intelligence that we've been able to gather and where we believe things may be headed in the near to midterm future. So with that, let's jump into our agenda. So for today's presentation, we will provide a quick overview of sustainable capital finance, and then we'll move quickly into the criteria we've used to determine those states that we feel are either excellent states for PPAs already, or those that are rapidly evolving into good states for solar PPAs in the relatively near future. Then we'll go through state by state, the top 10 states we feel have the most potential for solar PPA financing. For each state, we will provide some relevant statistics, followed by an overview that will touch on things like the current energy prices, the inflation rate of energy, and any local regulatory issues that may be, changing conditions on the ground for solar financing. Lastly, we'll provide some pricing examples that walk through the assumptions relevant for each state, so you can see how our PPA pricing might apply to your area. At the end of the webinar, we will reserve some time for Q&A, so we would ask you to save your questions till the end when we'll be happy to answer as many as we can. So, Sustainable Capital Finance provides third-party PPA financing exclusively for the CNI and small utility scale market. We work with a broad base of EPCs and developer partners across the country and provide both construction as well as takeout financing for projects on both the commercial as well as the nonprofit side of the market. The majority of our projects do tend to fall into the nonprofit category, including groups like schools, municipalities, HOAs, and some larger churches, but a significant percentage of our projects do fall into the commercial side as well. We finance more than 100 projects to date, totaling more than 200 million in CapEx, and we work with some of the largest independent power producers or IPPs in the country today. So let's review some of the basic criteria that we pulled from our database of projects that have been entered into the SCF suite to determine those states that we feel are the most attractive for solar PPAs. So the first stat we typically look at is the average cost of energy for each state. This stat, coupled with the cost to install a system in each state, provides us with the likelihood that PPA financing will provide energy savings. Next, we always want to know what types of incentives, if any, are available to see how this might improve PPA financing. We also look at the inflation rate of energy, as this has been the factor driving significantly higher energy costs across the country in the last few years, and has also been driving energy consumers to take kind of a fresh new look at PPAs in an effort to try and cap future energy costs. And then lastly, we want to look at whether PPAs and SSAs, SSA stands for Solar Service Agreements, are allowed in each state. For the most part, all of the states that we're going to present today allow third-party financing agreements like PPAs and SSAs, with Texas being one of the states that does have some local restrictions. So those are the primary criteria we're going to look at. Let's get started then with the big kahuna, California. California has very high electricity costs relative to other states, and that paired with its very large population make it the leader in solar PPAs in the country today. The average cost of electricity for CNI customers is almost 20 cents per kilowatt hour, with build costs averaging about $2.70 a watt. A note about average build costs: when we look at this figure, we are averaging a number of different types of projects, including smaller systems, in some cases as small as 250 kilowatts, up to multi-megawatt projects. We also look at rooftop, carport, ground-mounted systems, some with prevailing wage, some without, and varying levels of install complexity. And when we boil all these numbers down, this figure we're showing here is the overall average that we've come up with based on all the projects that were entered in 2022. The expected inflation rate of electricity in California is kind of anyone's guess right now. Historically, this figure has been solidly in the 4 to 5% a year range for almost like 40 years. However, in the past few years, depending on the utility, we have seen increases in the 8 to 10% per year range. And from what we've heard, this rate is not expected to really calm down anytime soon here. We will see this being a common theme in many of the other states that we present today. And then lastly, PPAs are definitely allowed in California. From an overview standpoint, while California has the most solar installed of any state in the country, The vast majority of that solar has been on the utility scale side, as the state has provided aggressive renewable portfolio standard percentages that have driven the major utilities to acquire gigawatts of wind and solar capacity. That being said, much of this utility level activity has slowed dramatically and in some cases has stopped altogether. The relatively untapped market in California, we think, is still the CNI space and believe that there is still significant potential to build out this portion of the market. The major fly in the ointment today is the introduction of our new net energy metering rules. They're called NEM 3.0. That are about to go into effect in less than 2 weeks. These rules will cause all energy that is backfed into the grid to receive energy credits that are wholesale in nature rather than retail. To put it simply, utilities will only credit backfed energy at an average wholesale rate of about 8 cents per kilowatt hour rather than the 30 cents per kilowatt hour retail rate that they've historically been offering. These NEM 3.0 rules will cause our industry to look for larger energy customers that are space limited and therefore are unlikely to really ever backfeed the grid or to add storage to their solar systems to avoid backfeeding altogether. The addition of storage will definitely add cost to these projects, but given the relatively high cost of energy already and the sky-high inflation rates within California, we still believe that California will continue to be a very solid market for solar PPAs going forward. Arizona's energy costs have typically fallen in the middling range relative to the rest of the nation. Current average CNI electricity rates are in the 10 to 11 cents per kilowatt hour range, which is, I would say, a little on the lower end for solar PPAs, but their build costs tend to be relatively lower as well. And SCF has had some very good success in this market. There are few, if any, incentives available, and Arizona requires us to use a solar service agreement rather than a PPA. The two agreements are relatively similar in nature, and our SSA has already been vetted in the state. The biggest story in Arizona is also the significant upward move in energy costs over the past few years. We're hearing stories similar to those in California, where energy costs have jumped between 6 and 10% recently, in a state where a 2% inflation rate has been the norm for as long as I can remember. From an overview standpoint, Arizona has one of the highest solar indexes of any state in the nation. Its energy prices have risen pretty significantly recently, and this is causing many businesses and nonprofits there to look at solar as a way to reduce energy cost spikes in the future. The fear of future energy price raises rather than saving a significant amount of money today, in our opinion, will largely drive PPA adoption moving forward. We believe this market is solid and will only get better in the future. Let's talk Texas. So Texas truly is, in my mind, the Wild West for solar. Energy prices vary pretty wildly from region to region, with some as low as 6 cents per kilowatt hour and others approaching as much as 15 cents per kilowatt hour. So I look at it as a little bit of a pick and choose kind of market. In a deregulated market like Texas, energy pricing is truly kind of all over the map. Build costs there have been on the lower side, mostly due to an almost, I would say, total lack of regulation there. And there are really no significant statewide incentives. I would say, like California and Arizona, energy prices have seen some dramatic increases of late, and they may actually accelerate going forward. We feel this is due to a number of factors. So first, there have been some recent weather events, like if you go back, Hurricane Harvey, and more recently, there have been a couple what they call polar vortex events from a few years back. And these weather events have driven major portions of the Texas grid offline for weeks, in some cases as long as months. Texas has few regulations when it comes to their grid, and it has really never been built out for the type of recent weather that it's been exposed to. And the Texas government has finally gotten the message and has begun hardening the grid, as well as catching up on a lot of deferred maintenance to hopefully head off some of the worst effects of this new weather environment that they're in. And this is expensive. It will require decades to complete. So we think Texas will be facing significantly higher energy costs for the foreseeable future. And while they are starting from a relatively low cost of energy right now, we believe that this is going to change quite a bit going forward. Our take on Texas is that there are some regions where PPAs can work. Think areas with power prices kind of north of 10 to 12 cents a kilowatt hour, and other regions where we're just going to have to wait for energy prices to continue to rise before PPAs become competitive. One thing to note about Texas, if you're pursuing projects there, please confirm that PPAs are indeed allowed in your area, as some utilities have banned them altogether. So just something to be aware of. Colorado. So Colorado has historically had a very low cost of electricity. Currently, the average is between 11 and 12 cents per kilowatt hour, but I've seen a lot of examples that projects entered in our suite here where power prices for CNI customers are more in the 7 and 9 cent range. So definitely on the lower end of the power pricing scale. There had been a performance-based incentive, PBI, within Colorado that historically had made some projects pencil there, but I would say most of that has been used up. Build costs there are very low, often under $2 a watt, and inflation rates for energy have also been on the low end as well, typically in the kind of 2 to 4% range. Therefore, it's been a little bit of a challenging market for PPAs. That being said, the state has launched their own community solar program that looks a fair amount like some of the other CS programs out there in the Northeast, like Massachusetts, New Hampshire, Maine, those types of states. Governor Polis has led the charge to convert coal and other fossil fuel-based energy systems towards more renewable sources like wind and solar. And as part of that process, many of the local utilities in Colorado have issued feed-in tariff programs to support the community solar initiatives. And in terms of PPAs for the short term, we believe that these FIT programs will probably be the most successful types of projects to pursue. With that, I'm going to hand off the reins to my colleague Matt Brown, who will be walking you through the remainder of the presentation. Matt, take it away.
Thanks, Dan. So on to Illinois. Illinois had historically not been a part of the solar conversation. That was until a few years ago, and the passing of the adjustable block program, creating one of the only contracted SREC markets in the country. Illinois opportunities can range in build costs, really depending on which part of the state we're building it in. But overall costs can range anywhere from 1.8 a watt to 2.5 a watt. $2 is a respectable average that we've accounted for. Illinois is one of those states who finds themselves dominated by a handful of energy utilities. In this case, it's Ameren and ComEd being the primary suppliers of electricity throughout the state. Our off-taker partners are seeing significant rate hikes from these respective utilities, leading them to pursue other forms of energy. And that's perfect, really, for a state that's growing a solar market born out of a strong renewable portfolio standard. Only came in 15th in total solar installed capacity, and projects are estimated to grow over 1,700% in the next 5 years via SEIA, which is 10th in comparison to other states. But despite this growth in capacity rate, Illinois and PPAs haven't always been able to meet their match. Costs prior to the last year haven't been super friendly, with avoided cost rates falling in that 6 to 9 cent range in some scenarios per kilowatt hour. But the past truly is the past, with costs rising and the Illinois AVP and smart inverter rebate in play in Ameren and ComEd territories. We believe with these increased rates and off-takers that want to be able to lock in rates, that don't want to be subjected to volatility, that the foundation truly has been set for Illinois to fulfill SEIA's lofty growth projections. On to trusty Ohio. Ohio has had a steady commercial presence over the last 10 years. For a while, it was almost 100% of Ohio's annual install, but that number has bounced around and regressed respectively in the recent years, with the inflection of utility scale in 2020 to 2021 and rising residential interest over the last 5 years, peaking this past year in 2022. Ohio is actually very similar to its semi-close Midwest partner, just a short 6-hour drive in Illinois, at least regarding cost. Build costs and energy costs float in similar ranges. Illinois and Ohio, that is. They're also very similar in their utility coverage, as in a few cover a lot. In places particularly of coverage by American Electric Power, or AEP, customers that we've spoken with are seeing volatile price increases that they haven't seen prior. This is definitely advantageous for a market that has historically struggled to connect on PPAs due to an oversupply in the SREC market, lower production factors, just a longer winter, and competitive utility rates from utilities like AEP that dominate a larger surface area of Ohio. But given all this, we still believe that Ohio is a competitive market. And given Ohio's business activity all over the state, it appears they're very much in line to build upon their already very surefire commercial presence and also fulfill SEIA's growth projection of over 8,500 megawatts over the next 5 years, which is fourth in comparison to other states. Next up is the great state of Maryland. Go Terps. Maryland's renewable portfolio standard was updated in 2019 to require that at least 14.5% of electricity sold in 2028 is from solar power. The bar just keeps on moving for a state that continues to aggressively pursue alternative energy projects. The state came in at 17th in total install capacity in 2023 after ranking 19th the year before. But CM only has them at around an average 28th in growth rate over the next 5 years, which might come as surprising to some folks. The historically robust market saw its SREC market start to become oversupplied in 2015 due to the large number of installs. These uncontracted SRECs are still available to offset costs and projects that see build cost ranges a little higher than average. I think we've put 2.3 a watt as the average we see for projects in Maryland. But the state overall has been a mainstay in solar install over the last 10 years, and because of it, naturally, buyers have reduced and the competition has remained. However, this is still a very lucrative marketplace, and with utility rate increases and access to the current SREC bids in the state market, it's very possible that developers such as ourselves will help Maryland hit that 2028 goal of 14.5% of electricity being sold from solar power. And with that, we are moving on to New York. New York is what the analytics might call a hot market. 10th in total install capacity to begin 2023 and 6th in projected growth rate over the next 5 years. All that data via SEIA. If you looked at the chart of New York's state annual solar installations, it's pretty incredible how steady it's been on its way to becoming 10th in solar install capacity. Truly an investor's dream chart if they were to have bought it before the curves started happening. But this is really in large part due to New York State calling for 70% of the state's electricity to be renewable by 2030, 6,000 megawatts by 2025 to be generated via solar. The 6,000 megawatts number is going to be tough. As of the beginning of 2023, they look to be around that 4,200, 4,300 megawatt number. So it's going to be a tough swing, but the foundation has truly been set thanks to incentives provided via the VETR and feed-in tariff through the Long Island Power Authority, and the work that the Reforming the Energy Vision docket is doing to advocate for DG altogether. Overall, SCF agrees that New York is a market to be a part of now and in the future. The costs will always be on the higher side, naturally. It's really all about finding that sweet spot on the right opportunity. Now, hello, New Jersey, you sweet distant cousin. No, I'm just kidding. I'm a Midwest guy, so I don't know anything about the relationship between New York and New Jersey. All I know is that New Jersey has been a mainstay in the commercial and resi markets over the last 10 years. They've even dipped their toes briefly in the community solar market as well, but have notably been more stringent on their available land. They really don't see the need for CS as much, though, as their entire state has been built to withstand a majority of their pipeline with behind the meter opportunities, a large portion of those being commercial opportunities. They were eighth in total install capacity in 2023, which was surprisingly up from 10th in 2022. So they're keeping it moving. See, it does show that even despite these total install capacity numbers, that they're around 24th in growth projection over the next 5 years, which isn't the most competitive, but really isn't likely to stop this state from falling out of the top 15 anytime soon. I'll see it and then I'll believe it with the state of New Jersey. Um, the only reason that they really would is if the market has just become so robust that it's increased to the point where there's more competitors than there are buyers. And while that may happen someday, it's definitely not today. And New Jersey is looking as good as ever heading into 2023 with their SUSI increasing and still a large portion of C&I off-takers still looking to join in on the solar fund. And finally, Massachusetts. Massachusetts is actually very similar to New Jersey, not only in surface area, but also on the fact they were both very early leaders in solar deployment. Mass really had a good run on the market between 2013 and 2017, and since we've seen more of a focus on community solar development as they've hit 472 completed projects and 796 megawatts of operational capacity in Q4 of 2022. Even with more of a focus on CS, they still ranked 11th in solar capacity heading into 2023, which was up from 17th in 2022. Massachusetts' growth outlook is pretty average, and that's likely due to the higher electricity costs leveling out the SMART program, lesser buyers now that it's sort of a developed market in some capacity, and just it being a smaller surface area state, accessing rooftops can be a little bit more difficult, and rooftop capability or availability is just on the whole a little bit smaller. All that being said, it will and can continue to be a good market for C&I solar as they still continue to yield respectable commercial install numbers. And that's very much due to their viable cost structures and off-takers who are very familiar with the process of solar development, whether they've done it before or they have other business partners or competitors who they're familiar with that have gone through the process and communicated to them to some extent. Now, we thought it might be a good idea to go through some PPA examples state by state. Starting in California, we wanted to look at a base case 500 kW project across the states we just discussed and roughly project day one savings we could support while matching current market rate build cost assumptions. Starting at the top, our best state for solar, historically at least, shows a respectable 270 per watt build cost based on a PPA rate showing around 20% savings on day one for the off-taker. With a nationwide industry standard of 10% savings on day one, this is a really attractive offer for a California off-taker, but particularly any off-taker in general. Moving on to New Jersey, incorporating the attractive SUSI program benefits, we're able to support around an 11 cent per kilowatt hour PPA rate based on the assumed 230 per watt build cost, which we believe to be in market for a 500 kW opportunity in the state. This again would show day one savings in the 20% range, which is again double industry standard and also showcasing the strength of these two states in our model. Now, savings projections are always going to pop in these two states in all financial models. So let's take a quick gander at some other states. Arizona and Illinois are showcasing savings a little closer to 5% or so on day one, while New York, Maryland, and Massachusetts are showcasing savings a little closer to the industry standard of 10% on day one. Again, these are based on approximate build cost assumptions. It's definitely notable that we aren't currently able to offer competitive pricing in some of the best solar markets that we've laid out over the last half hour or so, particularly those in Texas, Colorado, and Ohio. In situations where standalone opportunities may not pencil, we have looked to combine project sites where applicable. This often works for schools and municipalities. Driving up that total project size alters the economies of scale to make these projects work. In addition, with the worst of COVID and supply chain issues behind us, and equipment costs starting their downward trend while energy prices continue their upward trend, this will improve our ability to finance projects in more locations and in more states moving forwards. And that'll take us to the end of today's webinar. Go ahead and click the Q&A button at the bottom of your screen to submit your question, and we will get to these questions shortly.
Excellent. Thank you, Matt. So we do have a few questions trickling in here. We'll do our best to get through them. There was a question about whether or not this will be recorded and sent out a post-webinar, and it will be. So we will be sending this out probably later today, early tomorrow, at the latest here. There was a question about NEM 3.0 that popped up. Essentially, the question is, on the NEM 3.0 rules, is the wholesale rate applied to any kilowatts exported or only monthly true-ups? I believe it's going to be applied. This hasn't been completely fleshed out yet because we haven't seen the final regulation, but I think it's going to be for any and all kilowatt hours that are exported. So the credit will happen on a monthly basis, and at the end of the year during the true-up process, that's where you will see the credits being applied. Let's see. There's a question on what is the project size used estimated in the build cost range that were shown in all the slides. There is no specific system size because these are averages across, as I mentioned, anything from 250 kilowatts up to usually 2-3 megawatts. So it's kind of a gross average over all of those types of systems. In general, I think you could pick something along the lines of about a 500 kilowatt. Our average system overall is about 600 kilowatts. So I think if we were going for average system size, it would probably be somewhere in that range. There was a question here on whether or not we support homeowners associations, HOAs. Yes, we can. I'll tell you the critical piece there is getting copies of the incorporation documents. In the internal rules, we just want to make sure that there's a guiding council, if you will, that has the legal right to step into this type of agreement. But other than that, yes, we can look at HOAs. Let's see. Somebody asked if I can talk in a Scottish accent. I'm gonna defer on that one. Are you providing the financing for the PPAs, or do you work with the third party? In almost all cases, we are working with third parties. One of the bigger ones we've worked with in the past is Nextera Energy. I'm sure most of you are familiar with them. So that's that. Do we have a list of all the PPA states? I'm not aware if we have one. I think what they're asking is states where PPAs/SSAs are allowed. I think it's probably a shorter list to provide which states are not allowed. So that's probably something we can answer after the webinar. Do we finance solar farms? I think that question is directed at utility scale, and we do. Typically, our pricing, I would say, is competitive up to probably in the 10 megawatt range. Above that, there's quite a few players out there, institutional type investing. Think of those types of organizations that may have more competitive pricing. We try to stay in our lane. We really look at CNI, and small utility scale is the space that we're trying to support. Do any of these systems incorporate a battery storage system? Excellent question. We did not include it because it's complicated in how you model the savings analysis. Some states are very good for storage, a la California, some of the ones on the East Coast where they have incentive structures that are based, entirely around adding storage and what that looks like. What I'll say about storage, if you're going to look at adding storage, typically, we ask all of our partners to run an energy tool-based analysis to understand kind of what their cost of electricity is today. And based on that, we do it both with storage and without storage to kind of see if it's accretive, if it makes sense to add storage because we're adding, a lot to the avoided cost. And in those cases, yes, we will absolutely look at supporting storage as part of the total financing package. Question on tribal projects. Do we support tribal projects? Yes, we can. We've done a couple in the past, and we have a pretty good understanding of working with the Bureau of Indian Affairs. So if that's something you guys are looking at, we'd love to talk to you about that and kind of go through the process and see. Once again, looking at their incorporation documents, how they're set up, what their rules say about entering into these types of agreements. There's a question on in what ways do we partner with distribution companies? I'm not sure I understand that question. That may be related to sourcing for potential materials for projects. So if that's where that question is headed, we would certainly like to speak with you about that, because we're always looking for suppliers and lower cost suppliers for the types of systems that we're doing. How do you consider the different incentives per state within your pricing? Excellent question. What we do is within our software platform, the SCF suite, we can talk about that at more length. And if you want to reach out, unless you're already on it, we can certainly get you set up for a webinar to walk you through how it works. But it's a project pricing platform. It's online. If you're not on it already, we would suggest that you do. Super simple to use, it's free, and please reach out to us for a webinar on that. But essentially within that platform, we have we have all the states in there, and the vast majority of the incentives that are available. So you can just click on the incentive structure, put in the appropriate amount for your particular state, and we will calculate that as part of the overall PPA pricing analysis. Let's see, I think that's pretty much everything we had for today. I think we've worked through all the questions. If you have any additional questions, feel free to reach out to either Matt and I. Our deets are here at the bottom. We want to thank you all for joining us today. This has been fun for us to provide you guys with some feedback on where we think the market is. And we look forward to reviewing some projects with you in the near future. Thanks so much.